Isn't seeking efficiency in government and productivity a good thing? Is this going to be easy? Absolutely not. Does that mean that you don't try to do this? Like, are you kidding me?
Welcome back to another episode of Tank Talks. I'm your host, Matt Cohen. We welcome back to the Tank John Ruffalo to discuss the news and stories making headlines in the tech and venture capital ecosystem. Welcome back to the Tank, John. We're recording on U.S. Thanksgiving. I hope you got your wings and football gear on, because obviously everyone in the U.S. is off today, but we are working, covering off of the headlines today. So first things first, there's some more news coming out of the conversations we talked about last week regarding the undisclosed investor from China that invested in Neo Financial's recent round was uncovered somehow by the Globe and Mail. And it was released that it was revealed to be Chinese technology giant Tencent Holdings as the mysterious lead investor in Neo Financial's recent $80 million US equity financing round, which valued the company, I believe, at about $510 million post-money, which was obviously a significant decrease from its $1 billion financing round of $185 million in 2022. I guess the question that people are starting to wonder is, like, why did they not disclose Tencent in the beginning? Suspicions are, given some of the geopolitical concerns around Chinese companies owning stakes in Canadian financial institutions with access to Canadian financial customers' data, that seems like it could be where people are concerned. Now, it is reported that the deal is structured to make Tencent a passive investor with no board seat and limited information rights, trying to probably mitigate the concerns around data access and controls. But obviously, given that Neo is trying to, push their way through to be a open banking participant, to take advantage of the hundred thousands of customers that they can potentially have impacts on, what do you think are the potential risk of having a Canadian fintech leader like Neo accepting terms from a Chinese company like Tencent?
It was an interesting story just based on what I read. I guess what the confusing part for me is, first of all, Tencent is a very legitimate investor, quality investor. So no issues on that. And you're absolutely right. The concern, I suspect, was, having a Chinese-based fund investing in a financial services organization, and there's lots of sensitivity. If you recall, was it a year or 2 years ago, there was a startup bank in Canada that had a banking license that was backed largely by Chinese principals, and the federal government pulled the banking license. And the big fear, of course, is financial services is very, very sensitive, and there are geopolitical concerns there. The part that does confuse me is, if you did put in all of those right things in place, and I think that was very smart, then why not embrace the identity of the lead investor, who is a legitimate lead investor? And, my concern is, what was otherwise a great story, you've sort of, if all that's true, you sort of mishandled the excitement. And now people are going to start making up reasons why that was perhaps obfuscated. And so, again, I don't know all the details, but, if I was in Neo's shoes, I would have just come out clean and said, look, I get the geopolitical, but we did all of these things to alleviate your concerns, and it wouldn't have been an issue at all. I wouldn't have sneezed at it. But now it's even making me wonder, well, what is really going on there then?
Yeah, I mean, obviously a PR team dropped the ball on this one probably, but
I think so.
They probably could have just come clean with everything. It didn't seem like there was something to hide if there was.
It was a great news story.
Great story. Yeah, absolutely.
Great guys.
And if you put all the controls in place, then who cares, obviously.
I really like those guys a lot. And anyways, hopefully it blows over, and hopefully there might be a little bit of a lesson learned. But all I'd say to them is, get over it. All you can do is kill it and watch your data.
Yeah, watch your data. Absolutely. Speaking of companies that have been in the news as some of the pre-IPO leaders in Canada, is Montreal-based travel company Hopper recently reported in BetaKit that they are having a round of layoffs, reducing its workforce.
Yes,
a RIF by 10%. It's about 65 employees, including 20 from its direct hotel team. Now, this restructuring comes on the heels of renewing its partnership, though, with travel platform Expedia, which had previously severed ties with Hopper in 2023, last summer, over concerns that Hopper's features exploited consumer anxiety and confused customers. I'm not really sure where they got that from, but with the partnership restored, Hopper now is less dependent on its direct hotel team, I guess. Now, they've been shifting their focus, Hopper, for our audience that doesn't know, obviously, this travel booking platform to a more B2B focused offering, which makes up 2/3 of its revenue. And they formed partnerships with firms like Capital One, Air Canada, Nubank, and Uber to try to integrate its travel and embedded fintech solutions, as it seems like everybody is trying to do as well, aiming for profitability within 2 years and targeting $1 billion in revenue. Now, everyone has heard that Hopper is not currently seeking outside financing or planning an IPO anytime soon, but given the fact that they're back in the news here, what challenges do you think Hopper is facing as it kind of moves into this B2B program more and more? And how is their strategic shift going to potentially impact their path to profitability, in your opinion?
This latest 10% RIF followed a previous 30% RIF, which implies that they may have had, over 1,000 people. Now they're 600-ish. Now, that in of itself doesn't mean anything, because if you said to me, well, you're replacing your human talent with AI, that's exactly what you would expect to happen. So I don't have any insight on whether that was the driver. But in this particular space, one would think that AI solutions is well poised to attack this particular space. And maybe if that statement is true, and I don't, but I see no reason why not, the compression of revenues is probably at stake. If the compression of revenues is at stake, then you better get your costs in order, because you can't be burning cash forever. Hopper is, very successfully generated, material revenues. I don't know exactly what they are. I think Frederick made a comment that, they want to hit $1 billion of revenue in the near future. But if you're scaling up that much in revenues, you would think that, folks, you better stop burning, or you better figure out how to stop the burn. One thing I will say about Frederick, he is one of the greatest entrepreneurs that I have ever dealt with in my career. He's got a knack to pivot like no one I've ever seen. When we made the investment through Omer's Ventures, I think it was 2012. I think we had pivoted 3 times already, and this guy is tenacious. So I am kind of wondering, given Frederick's history here, is he really trying to find where is the right place to create an effective business model? And I do wonder if there is pressure, particularly on that top line, which is what's reacting. Now, the other comment is exactly what you had said about Expedia.
Well, yeah.
Now that they're partners, I'm sure Expedia say, hey, folks, don't compete against us now.
Exactly.
You're a partner. And that's the obvious reason for this particular rift.
Well, I think, a couple things here. Like AI obviously is something that people thought can do a lot of the work that these aggregator platforms have been doing for quite some time and benefiting heavily from. Hopper's renewed partnership with Expedia after a public fallout, says that there's obviously some interdependence between these travel platforms and aggregators. And how this is going to evolve into a competitive travel industry, we'll see if they've agreed on that on paper. But I think the other thing that I'm curious about is, when is Hopper going to start taking advantage of what other marketplace platforms are seeing in their revenue mix regarding advertising, right? Because you look at Uber, you look at some of these larger marketplace platforms, even Walmart, the advertising that they're generating in terms of revenue is a huge part of it, 1/3 to 1/2 for some of them.
Yeah.
So Amazon, Instagram, like
Walmart and Instagram. Instagram shifted to the advertising model. Yes.
I'm wondering where that's going to come into the mix for Hopper, because it has not come out yet. And
Interesting.
I'm hoping that they figure that out as well. So we'll see. But good for them to continue to be a partner with Expedia as the industry of travel starts to see a lot more competition outside of it. Now, let's switch gears to the US side of things. There's obviously a lot going on down south. One of the big headlines we saw this week was Sriram Krishan of Andreessen Horowitz, a former product leader at Twitter, is reportedly leaving the venture firm after 4 years. He was tasked with leading the UK office. He is a very well-known operator. He is a sharpshooter when it comes to being put into some significant management roles. Guess where he's going, John? Where do you think he's going?
Let me guess. Is there an acronym of 4 letters?
There sure is. There's discussions that he is talks to join Elon Musk about joining the Department of Government Efficiency, DOGE. Obviously, this is incredible news that more Silicon Valley heavyweights are gaining more and more momentum to join access to the White House. And in large part, obviously, due to Musk's relationship with Trump, he is bringing in the SWAT team to take apart this entire, inefficiency we're seeing in government. What are your thoughts on this? And is this the model that we are going to see replicated across the world? Obviously, Lex Friedman had Javier Milei. I listened to the podcast. He's one of the most brilliant minds in current, economic theory and application of it too, which is unbelievable as well. There's one thing to study, economics in the books, but then applying it is something that you don't obviously see happen translation. But in terms of what we're seeing with Doge, it feels like he's bringing in people that can think about things, but also implement them operationally.
Yeah, no, it is interesting. It's funny on this topic. It is remarkable how politically charged this topic is. And, I've made some posts on this where I'm really just trying to say, isn't seeking efficiency in government and productivity a good thing? Like, can we agree on that? And I'm not sure that all I get is noise of that Musk is a piece of shit and blah, blah. It's like, dudes, I don't care who's doing that, right? And, he's kind of the figurehead on there, but they're getting some serious folks. And again, is this going to be easy? Absolutely not. Does that mean that you don't try to do this? Like, are you kidding me? Like, you don't try to make your organization more productive? Is that what you're really saying to me?
The status quo is what keeps them comfortable.
Yeah. And, the thing about on Canada, should Canada be looked at this? Like, are you kidding me? Like, of course you should. And the thing is, the key words is, it's not the Department of cutting costs. It may be a lot of that, but it's efficiency. That is red tape, process, adoption of technology, cutting wasteful spending. I mean, like, I would embrace this in Canada. And by the way, it is starting to catch hold, maybe not by the current government right now, but this concept is getting a lot of traction with a lot of voters who are terribly concerned that without any constraints of spending, and we're capped at the amount that we can borrow. So what's left? Just keep on increasing the taxes to pay for wasteful spending. It can't continue. So I embrace this personally, and all I just keep on saying is, it would be great if we have someone, because this is not easy for someone in current government to do, because if it was, it would have been done. But having the private sector coming in to help be a catalyst, I think, is a phenomenal idea. And there should be more of that concept here in Canada.
I mean, there's a lot of names being thrown around as being potential supporters and helping out Musk and Vivek. There's Jeff Jordan, Connie Chan, Joe Lonsdale, Bill Ackman, all reportedly assisting Musk and Vivek with their government efficiency initiative, which is incredible.
By the way, I've had my friends in Canada apply to be a part of that, because they want to learn how to bring this across the board.
Yeah.
So,
I mean, there's talks around how if you have like Doge on your resume for the next 4 years, you will be hired anywhere in the world. It'll be like the greatest thing ever to have on your LinkedIn profile. One thing I also saw that was really interesting. So you saw how XAI, the OpenAI competitor that Elon Musk has created inside of Twitter. Did you see how he's making some of his Twitter investors whole by giving reportedly 25% stake of XAI to the ex-shareholders, basically to make them whole on the acquisition that they probably had at a lower mark than where they invested a according to the Financial Times. Pretty interesting, right?
It's very interesting because, what's interesting, and again, I think this was not Musk's intention at all, and he fumbled the Twitter deal, no question. But to suggest that Musk has lost because of the Twitter deal, not so fast here, folks. He has leveraged it in a way which I don't think he predicted it himself.
Oh, I'm sure he did. Oh, I'm sure he predicted the data available on Twitter that was not being used
maybe
train the
right.
next OpenAI was definitely in his cards.
I wouldn't have been smart enough to do that, but he has increased his net worth on all of his other investments, and looking at the XAI, the value there alone. So I kind of see what he's doing. He's kind of saying, you're investing in the Elon Musk group of companies.
Exactly.
You might lose here, but you're going to gain here. But overall, you're going to make money with me. It's very interesting.
Yeah, it's very interesting. And it's a great move to keep your partners close who've supported you through the ups and downs, obviously, which he knows very well. Another thing we saw was a lot of secondaries happening. We saw the iconic secondary transaction happen the other week with Wealthsimple, buying $100 million worth of shares from employees at a $5 billion valuation, which was the last high that the company had on their last financing round, which is quite interesting. One, there's rumors that there was an oversubscribed supply of shares for sale, meaning a lot of employees were hoping to sell, and they matched off with the demand of $100 million. But it also shows that the $5 billion price was probably on a pref round, is now being done on common shares because they're from employees' common stock, which means the spread between commons and prefs are pretty close. Therefore, probably showing that Wealthsimple is gearing up for a potential IPO in the near future, or, with a new CEO as well. That's an interesting thing that they're getting the cap table kind of moving into a more public position, don't you think?
Yeah, I guess the question is, Matt, you have to add the entire pref stack together. So let's just pretend and I have no idea what the number is.
Sure.
But let's just say it's $1 billion, right? All you have to do, though, is value the business clearly over $1 billion, and there's really no discount, right? And so whether the number, so if the number really is quote, the enterprise value is really $5 billion, I would say to you that the classes of the prefs and the common at that level are absolutely equal, because the preference doesn't matter anymore, assuming that they're just simple preferences. So my guess is there actually is no difference in the value between the two really at these levels. When a couple of years ago, when the valuation was written down quite a bit, it was getting much, much closer to that combined pref stack. And then you start to go, wait a minute, I'd rather have the prefs because I'm not so sure that I'm going to have at least my 1x back.
Yeah, it is quite interesting. I definitely...
The crypto's done spectacular for being simple.
Reportedly cash flow break even too,
Great
which
for
is
them.
phenomenal. 50s,
Likes to
8
start.
billion or so under management. It's amazing. And one last thing to cover off that you mentioned, and a lot of people have been talking about, is the ratchet clause and the clock that was ticking on Service Titan's IPO. I want you to explain to our listeners who aren't familiar what exactly is going on here, how a ratchet clause works, and how basically this IPO is not a factor of the company doing well and wanting to take advantage of it, potentially part of it, but really because the clock was ticking on how many shares they were going to have to give the investors who put this dirty term sheet together.
So for your listeners, the starting point of a quality VC really is either you're going to invest in common shares of a business or what we call simple preferred shares. And all it really is, it's exactly like a common share, except your money, the last money in is the first money out if things go badly. And that's a fair thing to do. When you start going beyond that, and we call it, you're starting to really structure that preferred share with bells and whistles, things like, dividend rates, accumulating dividends. There's various techniques that VCs do when they think that the founders are demanding a certain value, but you don't want to pay for it. So at the end of the day, it's a disagreement over the value of a business. So what you do is that you create these funky structures so that both sides are sort of happy. But the truth of the matter is, it's because you both don't agree on a valuation. And if things go spectacular well, then it doesn't really matter. But when things go okay or poorly, you have a mismatch of economic interest. In this case, what happens, a ratchet is if I invest $1 per share and I put in $10,000 and get back 10,000 shares, but in the future, based on a sales event or an IPO event, and there's a valuation established, and the valuation establishes that the value is now $5,000 and it never was 10. Instead of getting 10,000 shares, you now have 20,000 shares, which is the equivalent of a $5,000 value. It's ratchets, I would say to you, are generally distasteful. But what was stunning here, they had what was called a compounding ratchet, which I've never seen, which says as every year goes by, that not only in that example I gave you, not only is the difference between the 10,000 to the 5,000, but your 10,000 compounds every year by 11% in that example. So what happens is, let's say a few years goes by, your deemed value is 15,000. So what that means, instead of getting now 20,000 shares, you're getting 30,000 shares. So what does that all mean? You're diluting the crap of everybody else. And who gets nailed? The employees in particular. Because I want to ask the question, and I don't think it was disclosed, but I'm going to dig for it. What is the strike price for those employees? Did they use that nominal $10,000 value, which suggests that they will be underwater, or did they adjust for it? I bet you they did it. And that's the problem. You really screw different people, all because you want to hide the true value. That's why I disagree with this stuff.
Yeah, 100%. I think like maybe this is just going to be a forcing function for them to get public, clean this all up, and then move on and continue building the business. I mean, just for our listeners to understand where this all stems from, there was a financial clause from their $365 million Series H funding round in November of 2022, and the round included, quote, a compounding IPO ratchet. And this protective measure for investors set a deadline of May 22nd, 2024, which we've obviously eclipsed by several months, for the company to go public. And if missing this deadline happened, each quarter ServiceTitan remained private. It owed more shares to their investors upon an IPO. Obviously, as John has just said, diluting existing investors. Now, this IPO ratchet had specific clauses that the minimum valuation it needs to achieve at its IPO, which was the hurdle rate, increases each quarter at an annual rate of 11%. So initially, the hurdle rate was 84.57 per share, but it's now risen to approximately $90 per share. And the current estimates value the company's shares between 70 to 81.59 cents a share, way below the hurdle rate, which could lead to even more share dilution. So there is an incentive here for this Series H investor to push the price as low as possible, which is
as low as possible,
which is actually happens a lot more than people think in an IPO process.
It's perverse. It's absolutely perverse.
Yeah, it's very perverse. And this is why Bill Gurley's always said, like the Dutch auction, the direct listing, whatever you want to call it, is the way to go, because you don't have these incentives to get that pop. And the pop goes to all the flippers that come in on the IPO purchase price. So this is obviously an urgent situation, very different than maybe a Stripe. We don't know if they have it, but assuming they don't.
Or Klarna.
But these protective provisions in an IPO process are very, very scary to see. I'm glad that we're making people aware of it. I mean, if you're fortunate to go public one day, hopefully you don't have these things to deal with. But this just shows how strapped for cash some of these pre-IPO companies were in 2022. when the market was completely dry. And now we're seeing things come to fruition basically 2 years later, right, John?
I mean, I wish that the stock flies, and in which case it goes on beyond $90 and then it doesn't really matter. But, they did this because they had to do this, which perhaps suggests that the business is not as healthy. And I haven't gone through the full S1 yet.
The business is fine. This will be a blip in time and it will trade where it does on the first few weeks, but then maybe it will get back to just building a real business and they'll all put it behind them. So we'll see you until next time, John.
All right. Man.
Hey everyone, thanks for tuning in to another episode of Tank Talks. We hope you found today's conversation as insightful as we did. If you're enjoying the show, we've got 3 quick things to ask of you. First, hit that subscribe button on your favorite podcast platform so you never miss an episode, whether that's Apple Podcasts, Spotify, Google Podcasts, or YouTube. Next, follow us and stay up to date on upcoming episodes and behind-the-scenes content on social media with Twitter, LinkedIn, and Instagram. And lastly, share the love. If you found value in today's episode, share with a friend or colleague who'd benefit too. Your support helps us bring in more amazing guests and keeps the Tank Talks engine running. That's it for today. Until next time, keep disrupting and innovating.